Today we are talking about unlocking financial security and the reality about retirement. So
Yeah.
I guess we are having conversations with prospects and clients day in, day out, and we speak quite a bit about what's driving our clients and what's important about investing in property for them. And the responses are very similar. Most people are looking for financial security, stability, and financial freedom down the track because, if they don't work towards those things actively, the future, may look bleak. And that's what we would be going through in today's presentation. So, if you're watching, good if you could just consider your why, really, your why for investing and what's important about investing in property for you. So, obviously, we have some things that we commonly hear from people, ranging from people being stuck and wanting to enjoy life, all the way through to not fearing that they won't have enough in retirement down the track. And also, some people say they're paying too much tax. But I think the key challenge or concern that most people have is obviously they have a great quality of lifestyle right now. They're doing well, they're active, they're working. But the question is, will they be able to actually maintain this lifestyle down the track? So you might be feeling that you're stuck and you want to enjoy time with family. And that's what, clients often tell us, they want to enjoy time with family, or wanting time freedom rather than having to just go to work 9 to 5, 48 weeks a year. People often don't think of having assets to fall back on. And we find the sooner you start the journey, the better it is. And we'll come to an example in just a moment to talk about that. You might want to provide for your children and leave a legacy for the future with the choices you make, and pursue passions that you enjoy and meaningful work, things that you actually want to do rather than do that job and 9 to 5, which may not be fulfilling for you. You might like your work and you want work as a choice, and that's totally fair. Some people say, well, I want to generate passive income so me or my partner can reduce the work hours. And then retirement, you might only just have your paid off home and no assets to maintain that lifestyle that you've done, for say 65 years of your life. And after that, how do you maintain the lifestyle, especially with the inflation that we are seeing? And of course, what something costs today may not be the same in the next 20, 30, 40 years. And many people say their superannuation is not enough to retire on, and they might be paying just too much tax. So it could be just any of these reasons for you as to why you might want to invest in property or any other asset class for that matter. The important thing is you do something rather than do nothing, because as Sana said earlier, the sooner you start, the more compounding effect you will have, the more exposure you will have to multiple property cycles and all. So effectively, either you could keep feeling this way. It's a bit of a vicious cycle. You may be in a job, potentially a PAYG job or a contract. That is the only income stream you may have at this point in time. And that's one point of failure, effectively, your job. So in this day and age, often people get made redundant, their roles don't last, or, there is technology advancements, for example, and people may not have the skill to compete with newer graduates. So you need to take control of what you're doing rather than leave the control to your employer. So the idea really is you arriving at a point where you actually feel secure and actually have something to fall back on. If you do nothing, nothing changes really, right? So you need to actively do something about this. So we wanted to today touch on, obviously, average superannuation balances, because obviously, superannuation is a bit of a forced saving for retirement down the track. But it's important that we look at facts and numbers, really facts and figures, to see where do you stand. So the average super balance by age. So this table gives us average super balance by age. So it would be good to see where you fit in this, really. But say this is from the Deloitte average balances as at 30th of June 2022. Say by the time someone retires, on average, they'll have $322,000 for a man and $246,000 for a woman, which is about 568 or 570K approximately in super in retirement. So So how many years will this balance last you? So assuming that, you are fitting in that average balance of 570K and you're between 60 and 64 years of age. And say with inflation and potentially more healthcare costs as you grow older, living costs, say your average living cost per month might be $5,000 a month, which is $60,000 a year. So this is assuming your mortgage is paid off and you have no dependents at all. And say you hypothetically you put aside some funds for holiday and discretionary spend to enjoy your retirement, say $1,000 a month, that's $12,000 per year. So total of $72,000 effectively you need to spend to live a comfortable retirement. And also the Association of Super Funds of Australia Limited retirement standard, as per March 2023 quarter, a couple's household budget is about $70,000 per year. So if that was to go by, $70,000 per year for a comfortable retirement, $570,000 will actually last you about 8 years at most. Obviously, we haven't taken into account the compounding effect on that.
And the inflation.
Yeah, there's inflation that will erode some of that balance as well. So what does it mean for you if you run out of money in 8 years? What would that look like, or what would life actually look like for you?
There's 70,000 before we know it. With inflation, right, becomes $100,000, and the same funds might last you less than 6 years. And that's based on the average balance. It's not even, relevant to majority of the population. Yeah.
So, so far we've looked at average balances. But these average balances are probably skewed by higher super balances. When we look at median super, like the middle amount, so it might paint a completely different picture. So the median super balance for men is actually $178,000 and $137,000 for women. This totals to $315,000.
So nowhere near the 570K, which is skewed by the higher balances.
That's right. And based on annual expenditure of $72,000, assuming you've paid off your mortgage and don't have any dependents, this $315,000 will last you just over 4 years. So imagine what life would look like, right? Like, say those 4 years you may live comfortably. What happens beyond that time frame? So what's possible for you, really? So we've illustrated this using like a property purchase of $600,000. So say hypothetically you invested in property, say you have equity of $145,000, which would fund a $600,000 property. For simplicity here, we've used interest rate of 6.19% principal interest repayment, so you're progressively paying the loan down over time. And we've assumed average capital growth of 5% per annum, compounding. So just note though, capital growth doesn't happen on a straight line basis. Over time, it may average to say about 5%. So that's what we have used. If that happens and you've got the 600K property, in about 15 years, you'll have net equity of about $904,000 in equity. And that's capital growth of 647K. So starting from 145K, you end up with 904K all up in the end. Here you've turned 145K deposit and stamp duty costs into an additional $647,000 just with the help of leverage by borrowing and buying a property.
But what you need to compare this with is leaving the 145K in your savings account for 15 years. Would it be worth an additional 647 on top, or it would have really eroded based on the inflation numbers and just money losing value or cash losing value? So where is it better? And what if you had exposure to 2 property cycles as a result of not just 15 years, if you had 30 years exposure to the property cycles? And this doesn't even take into account the rental increases, and especially in the current climate where we have a shortage of both houses to buy or any type of property to buy and also rental properties, and it's all compounding capital growth and rental increase to pay off the property faster as time goes on.
So you have to consider, right, like are you on track in terms of, obviously you're building that super, and if you're doing nothing, then we've shared obviously what you may end up with. on the median being $315,000, or at most, say, based on the average, $570,000, which is a very skewed number. It's very much, dependent on higher balances, right? It's like it's 570K is much higher than what the median is. So you need to consider what your resources are right now. What are you making the most of your resources? Are you taking action in the present moment whilst your resources allow you to do that?
Also, you might be thinking, if I need to go and save up the 145K, or, well, that's one option. Do you save up? But if you are an existing homeowner or an investment property owner, you might already have that 145K equity in there that can be tapped into and for investing in other properties. I've also seen people say they actually went and sold a property thinking they'd have to sell a property to buy another one to release the cash. But no, you don't have to. We can top up on the current loan if you have enough equity in there. So you don't need to go saving up the 145K. You don't have to go selling a property to acquire that 145K.
And also, if you have less than 20% deposit, or if you don't have sufficient equity, then there are options where you could choose to pay lender's mortgage insurance to get into the property market and start getting that exposure to the market, and maximize the time you're exposed to the market. Too often people sit and say, oh, they'll save up that 20% deposit and not pay lender's mortgage insurance, and ultimately they end up missing out because the property market may move by that point really. So you'd rather be in the market than not be in the market. We see lender's mortgage insurance as a cost of doing business to giving you that exposure. It's just a price to pay to get in, to get the exposure, maximize your exposure. So don't necessarily wait until you have a 20% deposit. We have used that for this example, but you can do with, say, 10 to 12% deposit. So now I guess we just wanted to add this on. Obviously, we've looked at the compounding growth in the previous slide. So we just want to show the historical growth chart. Yeah. Obviously, as you can see, the trajectory is on the way up over the last 30 years. We have spoken about this in our previous lives. It's not necessarily going to go backwards because of what's going to be happening in our country over the coming years.
Well, if you see houses, right, in 1992, combined capital city houses values were sub 200K or even less, and right now they're 928K, and units at 636K. That's in the metro or capital cities, and regional started less than that, sub 100K, and regional houses are about 623 combined values. So yeah, in terms of the percentage change, right, that's huge. And would someone have been able to save up, say, 928K and not lose value of that money, or instead have it in a property growing over time? And you do the work once and it pays for the longer term. And then moving on, just this CoreLogic report, again, starting in 92, combined capital cities growth being 928K for the house prices. And as you can see, there's lots that's happened. There's been first home owners grants, there's been GFC in the middle, we've had pandemics, and even tightening of lending, or APRA putting in their speed limit and limits on interest only loans. But that really has not deterred people from continuing to invest. Sure, it's harder because the lending is tighter, but rates go in cycles and properties go in cycles, right? It might feel a lot harder to get into the market right now, but when things do ease up and the masses go into the market and push the prices, and especially with the population growth, you would have the equity at that point, and also potentially not just equity, but potentially a borrowing capacity as well freed up. And that's what we've seen with our clients in particular, where many of our clients say got into the market 2017, 2018, when lending was quite tight, and people went to lenders of last resort, and then we saw lenders which were needed at that hour to get into the market, and then we saw refinancing of those properties to, say, from non-bank lenders to bank lenders, and the cycle continues. And we have at the moment clients who are not able to borrow with bank lenders, borrowing with non-bank. And when the time comes, they will refinance to bank lenders, release the equity, and then go again investing, because again, rates go in cycle. It's at some rates can go up and rates can go down, but at some point they will have to come down, because that's just how the economy works.
Yeah. So if you'd like to speak to us and also look at your property portfolio and look at expanding a portfolio, whether it be on the finance front or looking to buy the right investment property, And to discuss your specific scenario, you can set up a time with us and our team. You just need to go to this link, meetme.so/property twins. The team will be dropping in the comments below of this live the link to our diary, and you can set up a time there.